Welcome back to another episode of FPO and G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about oil and gas entrepreneurship, right, Justin, before, and kind of what that means and what's to be considered and the tax implications and when you're financially independent. But Justin, before we dive into it, what is oil and gas entrepreneurship?
Jared, I want to do 3 different case studies on this idea. And so we've talked about this before, that in oil and gas, there's a really huge difference between a career path where you're going to work at a super major for decades. Compare that career path to one where you're going to work at a smaller privately held company, and you're likely going to either have multiple liquidation events, or maybe you have one giant liquidation event and you work for the company, you earn some equity, buy in for some equity into the company, and then you have an exit event, and that is going to give you a lump sum of money all at once, typically significantly younger than the normal retirement age. And so that brings with it a whole host of financial planning challenges and opportunities. And so I think it makes sense for us to do 3 different case studies. One is, first case study we're going to do today is, let's pretend that this is a younger family that goes through this event. So they may have equity in their company, or they may have equity in a potential venture inside it of their company, that maybe the company is not selling the entire company today, but they're going to sell off this pipeline or whatever the case may be. And so you're a young family and you have a significant liquidation event. The second case study I want to do is, maybe you're not quite as young. Maybe you're in your 40s or 50s, and maybe your payout is a little bit bigger than the one we're going to do today. And then the third one is more of a full-on, okay, this is a financial independence event. Maybe it means that you're 55 or 60, or maybe it means that the amount of equity that you own and the payout that you're going to get is so substantial that you could immediately stop working and have a whole host of tax and estate planning considerations that it would bring with it. And so I think the idea of entrepreneurship is, you may not be the founder. Now, to be clear, I think the third case study, we probably will look at the case study of a founder where you're getting an 8 or 9 figure payout or more. But with entrepreneurship, you're not necessarily the founder, but you have an equity stake. And this equity stake is going to bring you a level of financial reward a whole lot bigger and faster than kind of the traditional W-2 career path. And Jared, I mean, I feel like we just have countless examples recently in the news. I mean, we think about the last year or so, and really it's been going on longer than that. There is so much M&A activity in the industry that you could do any sort of Google search and you're going to see, and we'll just read some of them. So ARM Energy and PEMCO announced a pipeline deal to the tune of like $2.1 billion, I believe. This is just about 6 months ago. Momentum Midstream, this has been in the news recently this year, Q1 and Q2. So EnCap Flat Rock Midstream is considering a sale of gas pipeline company Momentum Midstream for over $5 billion. And so that was in Bloomberg just a few months ago. Podcast guest Bob Phillips sold Crestwood equity for $7 billion a few years ago. Interesting, he's now on the board of Western Midstream. I saw that about a year ago, so pretty cool there. We are recording this in Fort Worth, Jared, so I mean, it feels like just about every year Double Eagle has some massive $1 billion sale. And so there's countless examples of this in oil and gas. And I think it's fun to dive into this. But what else would you add about the idea of entrepreneurship?
Yeah, I think just succinctly, it's somewhere in between entrepreneurship and a W-2 role, right? There's some asymmetric opportunity with whatever economic package you have, right? And again, what we're seeing is 2 dimensions. You can have a meaningful liquidity event because I co-invest in a deal of my small privately held company, or I own equity or profit interest units in that entity, right? And so entrepreneurship is, or oil and gas entrepreneurship that we're calling it, somewhere in between the spectrum of W-2 and wildcatting.
Yeah.
Right. And I think we're seeing increasing amounts of that. I think there's a baseline amount of that will continue to happen, right? Like, there's this great chart from Deloitte, and it looks at M&A M&A by upstream, midstream, oil field services, and downstream. Over the last 10 years, average, $120 to $150 billion in transactions, right? And so I think that's going to continue.
Wow.
And I think people need to be aware of that, right? I think, honestly, we need to have another conversation where how do you balance the trade-offs between W-2 or this more entrepreneurship route? But let's say you have already selected the entrepreneurship route. What do you need to be thinking about?
I love that. So should we dive into this first case study?
Let's do it. Set the stage.
Okay, so let's take a hypothetical person who is at one of these companies, and let's just say they're in their 30s and they're married with 2 kids. Now, one thing that is very important to call out, in a lot of these situations, you may be in a kind of compensation structure where maybe you are making great money, but Jared, it's also really possible that maybe you're making good money. So you might be making a couple $100,000 a year, but you have a material equity stake. And so you're making good money, but now you're about to get a payout, a liquidation event that is obviously way, way more than your annual income. And so that's what we want to think through today. We want to consider, hey, what are the decisions that you should make in the short term and long term? How should you allocate that if you get an exit event and now you have millions of dollars? What are your most important to-dos? And how should you think about future work? Because again, this case study is someone who's in their 30s. And so for most people, unless the number is really, really big, you're not going to stop working. And so we want to dive into all of those things. So, Jared, I think let's say that this is a family who they have it could be a $2 million or $4 million after-tax chunk that they now have after this exit event. And where should we kind of dive in if this is a family in their 30s with 2 kids and they get $2 to $4 million?
So an interesting thing is think about this exact couple, but go back 3 years. How much should they be saving in light of this? You know what I mean? Because
wow.
that's the thing. Because this liquidity event is huge. It's if you talk to anybody at the water cooler, it's probably inevitable, right? Because everybody's super bullish and optimistic. But how do you think about We'll just take a step back. How do you think about saving if, hey, my net worth based on the most recent round of valuation is okay. I got $3 million, but 2.5 of it is in this small, privately held either deal or company ownership that I have no control over. Should I be saving above and beyond that, or do I just let it ride? How would you mentally account for that before the event has happened?
That is such a good question, and I'm glad we're doing 3 case studies. So in this case study, again, it's a younger family. So one important detail is this is their first liquidation event. So they have not yet had a giant payday. So I think what should be true before a deal ever closes is live well within your means. And hopefully you are hitting a 10 to 20% savings rate. But I think the key attribute there, again, if you're in your 30s, you're probably not making $900,000 a year and have a giant equity position. A lot of people in this role, they're making good money, not great money. And so following the financial planning basics are key.
Yeah, and I would probably specify below market wages relative to their expertise, right?
Very
when we
well
see
could
people
be.
take the entrepreneurship route, a lot of times your base salary is underwhelming.
Yeah.
Your bonus bands are wider. And then, of course, these ancillary compensation levers enter the chat. So, I mean, I think the first thing that these people should focus on, I don't think it really changes, right? Like whether you have a $2 million liquidation event or this, you need disability insurance, right? Like if you think about this person, I know this is not a sexy answer, but it's the right one, right? Still, most of your value is tied up in your future earnings. And I know it doesn't sound like it because you just got a big liquidation event, but no, if you've made this much in your early 30s, you have decades more to make a ton more, right?
Yes.
So I think insurance needs to be in place, right? I think estate plan needs to be in place, right? Figuring out who gets what, especially if you're about to have this liquidity event, you probably have kids that are minors, so you really need to think about, okay, who would take care of my kids? And if they got this money sooner than anticipated, how do I want them to get this money? Because I have minor children inheriting this money. It's not like, if you're in your early 60s and you have college age kids or kids that are, in their first job out of school where you might be comfortable with them getting it in one lump sum. I'd probably want to think more about, hey, what are the do I have all the documents in place? What are the mechanics of my estate plan if my minor children end up getting some of this liquidity?
That's a great thought, Jared. What's interesting is we have had several of these conversations in the last, I would say, couple of years. And one in particular that comes to mind. So, Jared, you great thoughts there, because you're talking about, hey, what should be true of your financial plan before the liquidation event? And you called out disability insurance. Probably the single most important part of your financial life if you have children. But I want to mention this because one of the conversations we had, it was with Nathan Steele. Nathan's been on the podcast. He is a partner at our firm at Brownlee Wealth Management. And he was talking to a family that was going through a liquidation event, and it was a wonderful size deal. And Nathan actually made the call out that still, after the exit event, even after you have this wonderful amount of money in your investment account, the most important thing in your financial plan is still life and disability insurance.
Right.
Because if you have young kids and, let's say that after tax you're getting $2-3 million, that is almost certainly not going to be enough money to not work for the rest of your life. And so Nathan actually specifically said, not just, hey, life and disability are important, but the most valuable asset is not the $3 million in your investment account. It's the present value of your future earnings. So that statement is always obvious when it's a 28-year-old who's a sharp person and is probably going to make a lot of money in their life. But it's even true after that 28-year-old is now 34 and they have a $3 or $4 million liquidation event. Still at that point, the most valuable asset in their balance sheet is not that $3 million investment account because of the exit event. It is the present value of their future earnings.
Exactly. Yeah. And I think, securing it before the transaction is valuable, because if you try to secure disability and life insurance with no employment income, it probably throws a wrinkle in it.
That's a great point. So that is a huge question mark. If you're going through one of these events, are you still going to be an employee of the company after the event, or are you going to be unemployed for a little bit and looking for a job? That has huge implications for insurance, which is the point we want to talk about here, life and disability. The next point is going to be called, what are you allowed to buy if you have a big exit event? Going to have a lot of implications if you're wanting to buy a new home and you're wanting to finance it. Are you an active employee or not? Really hard to get a mortgage if you're not.
Right. So there's a ton of things I'd say before the liquidity event. Like, I'd figure out what you want to, how are you going to allocate that, right? And again, us as investment managers, we think, I don't necessarily just mean allocate across an asset allocation and an investment account. No, I think, what do you plan to spend? What do you plan to give? What do you plan to buy, right? And what levers of liquidity do I have? Yes, you have a big slug of cash, but is that the best thing to use to buy the future home? Since mortgage interest is deductible, right? And so just thinking through, hey, what are the line items that I have? And I would argue for anybody, you probably want to spend a little bit of it, right?
Right.
I think the worst outcome is, you get to that big transaction and all of it goes to savings and you act like it doesn't exist, right? I think, you got to make the journey enjoyable. But there's probably some of our audience that's like, hey, if I don't spend it, then maybe I'm financially independent. I'd be curious what you think about that. I guess it depends on the after-tax value of the number.
I'm guessing a lot of our listeners have heard of the term FIRE. So there's kind of a community over the last decade or two that's become popular. FIRE is Financial Independence Retire Early, FIRE. And I mean, Jared, I just really don't agree. I don't connect with those ideas of that community at all. Because the general idea is live with as low of a kind of cost as possible, keep your expenses down, and that allows you to save more, and it allows you to hit financial independence and potentially retire in your 30s, 40s, or 50s. Well, I'm with you, Jared. I think if you go through a big exit event, if there's things that you enjoy spending money on that can bring value to your life, do it. The financial planning answer is always don't spend anything, invest everything forever, and never stop working. And I don't agree with that at all.
Yeah, right. If you have the big liquidity event, go live in Mallorca for 6 months with your family, right? You can always make more money, but that opportunity with your kids at that point, take a gap in employment, right? And maybe you don't have enough to spend it all. But I think FIRE is rooted in this idea of my job stinks. I want to hit the eject button as fast as possible, even if that means short-term pain. And I just think all of that is just so fundamentally rooted in a scarcity mentality, right?
Yes.
My job sucks, but it's the way I make money. How do I make as much money as fast as possible so I can hit the eject button? The problem is that doesn't have a definition of what the good retirement life looks like, right? So you'll read all these articles about these people that did in fact fire and get to the other side and realize, oh crap, all of my friends are raising their families and working jobs and I have no one to hang out with. And I have no clarity in terms of what I want to do.
Yes.
So I think there's a real lack of like purpose translation there. So like, I would argue even if the numbers support it, you're probably not going to be happy, right? Like if we take a case study of our clients, even retiring mid-50s, most of them go back to work in some form or fashion. Just turning like intellectually demanding, challenging career in energy to doing absolutely nothing is a tough switch. So most people do something. So I think, if you're thinking about, can I retire? Yeah, that's an interesting thought exercise, but not particularly helpful. Because I think what's the probability that you retire indefinitely right after that liquidity event? I would say very low.
I love the phrasing there. You use the word, my job stinks. So I want to get out of my job as quickly as possible. What an incredible thing if you can find a job that doesn't stink. I want to make sure we hit on something with insurance before we move on, but I was playing golf with someone a few days ago, and they have a very demanding full-time career, but then there's someone who invests in a ton of real estate on the side. And so, I asked them, so at what point do you just want to stop what you're doing and really go into real estate full-time? And it was kind of interesting because he made the point, I do want to do that at some point, but I have seen older colleagues do it and I've seen a potential problem. And that is, I've seen colleagues do it while their kids are still in school. And so they think they're leaving their job, going into this period of life where they're retired, they're free. And well, they're still totally subject to activities and school schedule. And so they're not actually able to do the things they want to do. And so kind of an interesting thing of another reminder that work isn't necessarily something that you should just try to escape as quickly as possible.
Right. Yeah. And I think, so there's really two parts to this conversation of, hey, I have the liquidity event. There's a question of, can I retire if I want to? Like that's a math question. And then should I, which is more existential and more purpose driven. So I think on the, should you retire? The answer is probably not full time. Right? Like again, maybe there's a sabbatical, but I think just saying, hey, I'm not going to do anything is a really tough sell, and probabilistically you'll get bored. But okay, let's say, so should you retire? Probably not from a purpose, contribution, but can you? I think is another interesting question, just mathematically, right? Let's say it's after tax and it's $4 million. You think somebody could retire on that at 35?
Okay, 35, you have 2 kids. Can you retire with $4 million? $4 million
after tax.
Jared, I am going to say you better have zero lifestyle creep. You better have a house that is you purchase for under $500,000, and you better have expenses that are like $10,000 a month or so, somewhere in that ballpark. And I'm saying all these things. Some of our listeners are either Boomer or Gen X, and they were able to pull that off. But we're talking about someone who's in their 30s. That is extraordinarily difficult to the point of being impossible. And so, by and large, the vast majority of people will not be able to retire because huge difference there, and this ties into kind of disability and life insurance. You're not financially independent until you have enough assets where your family could live off of those assets in perpetuity. And that's the definition for financial independence. It's also the definition for being self-insured. And so life and disability insurance are, interestingly, the most important thing in your financial life if you have kids. But then at some point, you have enough money and you're self-insured. And all of a sudden, not only is it not less important, but it doesn't matter at all. Like it goes from most important to irrelevant if you hit self-insured. And so, Jared, my hunch is vast majority of people cannot retire if they are 30s, multiple kids, and a lot of my assumption there is that they bought a home with horrible interest rates at a higher price post-pandemic. What do you think?
Yeah, I think it's a function of what is your family formation at this point, but I'd say probabilistically no. You probably haven't bought in the forever home if you're 35, right? So you need a home upgrade. Also, we've talked about a lot of insurances. If you're on the hook for 25 years of health insurance privately, out of pocket, that's a huge expense.
Yeah.
Right? Like, and so I think, could it be done? Yes. I think the odds are against you unless you are kind of taking a trajectory of really reining in spending, right? Or taking advantage of what I would call like location arbitrage, where you move to like a Kansas City or a Midwest or like a place where there's just like, you can recreate your lifestyle for a fraction of the cost of living in a big metro city.
Right.
So I think absent those two things, probably not. But again, that's okay. It's not a big deal. You could run if that was really important to you, you could probably run an analysis to figure out exactly what you could spend, and we could help somebody engineer that, probabilistically, probably not. And then is that even lifestyle optimal? Also probably not.
One of the most important things we do with clients is just dive into the weeds of cash flow analysis throughout their life and understanding, okay, I have different assets in my balance sheet with different tax implications. How much can I take from my investments to recreate an income? So huge call out here, Jared, if you are retiring in your 60s, 65, well, you could probably have a safe withdrawal rate in the 5% range. And, I don't want to share this too loudly, but potentially 6%. So you can go well above 4% in certain circumstances, but this case study is not a 60-year-old.
Right.
It's someone in their 30s. And so a safe withdrawal rate at that level, if you're wanting to full on stop work and live off of investments, you need to be more in that 3% range. 3.5%, 4% would be the absolute ceiling. And that is a gross number. So 4 million, well, 3% of that is 120. Maybe it's 3.5. So maybe you're 140, but you're going to have some capital gains of some sort.
Right.
Maybe you're able to get it all at the 0% capital gains bracket. With those numbers, it's possible. But again, it just goes to show the point you just made. You have to have a very specific lifestyle and expense setup that allows you to live significantly cheaper than most people in DFW or Houston that are that age.
Right. But that's the thing is like, the question is $4 million enough to retire after tax? For a 35-year-old, no. For a 65-year-old,
yes.
Probably.
Potentially.
Like, again, there's a lot of variables on the other side of that, but
who could turn on Social Security
right.
And has Medicare.
Right. And then if you're funding, if you're, your life expectancy is age 90, you've cut the number of years your portfolio needs to provide income in half. The 35-year-old to the 65-year-old, right? Your retirement time horizon has gone from 60 years to 30 years.
Not the point of this podcast, but Jared, very important to share this. We've talked about this a ton. That's why it's insanely valuable to have any amount of income from, say, age 55 to 65 to just bridge that gap and shorten the amount of time that you're living off of those assets by a decade. And then you get to have a higher withdrawal rate from your portfolio. Now, Jared, the point of, or the label of this topic that we're talking about is, what are you allowed to buy? Which is kind of a fun thing to talk about. So let's say that you do make 3 or 4 million. I will say, if you're going to continue to work, like you can massively upgrade your home. And so I think that's okay. And, does that mean that you buy a $1 million home or a $2 million home or something more expensive? We could totally get in the weeds, and maybe we should. But, I think my first answer there in a general sense is absolutely. You can go do that if you're going to keep working.
Yeah. I think allowed is such a funny word. Like, you could buy whatever you want, you're a grown up, but it's all about trade-offs, right? Like, that's the thing. With this amount of money, you could do anything you want, but you can't do everything, right? So just figure out like what is important to you. And if it is the home, great. Let's build that into the plan and work around that. But I think you can't do every single thing you want to do and then never work indefinitely.
You could take 6 months and go to Mallorca, just like you said, and then go back to kind of career after that.
Right.
You could sell your home and go buy a $2 million home. Now, we've talked about this on the podcast. If your work situation, your family situation allows you to live in a more affordable place, that's fantastic. But there are some people in the podcast that, whether it's work, whether it's family, it just is significantly more conducive to your life to live in the heart of Houston. And if that's the case, there's plenty of examples where just to be in a good school district and be within 15 minutes of your work, or maybe it's your family, well, that's not going to be a mansion. Even if you're spending $2 million, it's not going to be remotely close to a mansion. And so, there's absolutely the ability to do that. And then I think having an understanding that it is possible, and this goes into, Jared, what kind of work are you going to go into after this exit event? Because if you're going to stay in this ecosystem of, hey, I'm going to make good money, not great money, but I'm going to keep taking swings where I have an equity stake for big future potential payouts. Well, you could be in a situation where you upgrade your home, but then with your kind of big investment account that you now have, you might have to take some distributions to supplement your lifestyle, which sounds a little bit insane to be doing that in your 30s. But if you're on a clear trajectory where, hey, this is your work and this is how you're going to be compensated over the next 20, 30 years, I think that's completely reasonable.
Yeah, and there's potentially a tax case to be made, right? Like if I'm distributing from a portfolio and I'm subject to cap gains versus, taking money from a retirement account where it's a potential income tax. Like if I have to take out of that so I could fund a retirement account and fill up that bucket, I think there's some arbitrage to be had there, right? Because you have 60 years where you need to recreate a paycheck, right? And you've decided to work, so you're naturally signing yourself for higher income years. So, and you have most of your money as an after-tax account.
Yeah.
So like you have the opposite problem of a lot of people who are retiring from super majors where they have the IRA tax time bomb. You have very little in an IRA account and a qualified plan. So like I think there's a case to be made where even if you are taking distributions from that account to funnel money into 401k, it's not a bad idea.
And so, Jared, whether it's maybe you had an equity stake in one of the news articles that we mentioned, maybe you're at Momentum, maybe you're at ARM Energy, or one of the literal dozens of others with all of the M&A activity, I think your first point, Jared, is really interesting. How should you be acting before the liquidation event? Because it does influence after the liquidation event. So we are diving into an example where you have an exit event, you have $3 or $4 million, but you upgrade your home. So you might be taking, I would say, try to keep it to a 2% distribution withdrawal rate to supplement your income, because you're going to go back to work. Maybe you're making another $200,000 a year, but that may not be enough if you have multiple kids and you're living in Westview, but you're continuing to take swings. Your expectation is this is not your last liquidation event. And so I think it's reasonable. I don't think you're breaking any financial planning rules if you take a 2% withdrawal rate from your portfolio to supplement your income. And I think that might be a little bit controversial in financial planning circles because you can't count on the future liquidation events. You don't know if they're going to happen, but that's why I'm saying don't take a 4%. You bought too much house if you need a 4% withdrawal rate. But if you're taking 1% or 2% and you have a reasonable chance at future payouts, I'm okay with that. What do you think?
Yeah, I agree. I think, right, what we're trying to do is get listeners out of dualistic thinking, right? Where it's like, either I am retired or I keep working. No, what if I work part-time? There's a third way, right? What you're talking about is, am I living off my portfolio or not? I think there's a third way where you say, hey, I'm taking a little bit, but it's a marginal amount.
Right.
So I agree. I absolutely think you could take some from the portfolio. And I think, quite frankly, you should, especially if you don't have any big expenses and you plan to continue working. I think there is an interesting case to be made. Hey, getting back to our job as investment managers, your household asset allocation. Okay, if I made all the money taking the big swings and I had this big liquidation event, I would probably recommend a portfolio that's boring, right?
Yes.
Because, right, like just take some chips off the table. Don't redeploy all this capital into all your buddies' deals doing similar amounts of things, right?
Yes.
And then, because that gets into a problem, if all your money's private, then you actually can't take 1% to 2% because you don't have anywhere to get it from.
That's right.
So I think it really comes down to, yes, absolutely, but also thinking about global asset allocation. You need some money that A, that's accessible, and B, that is kind of, I would say, more vanilla in terms of investment construction, especially if you're human capital and then, a lot of your equity compensation is tied to more volatile M&A in oil and gas.
Jared, I feel like we keep going on different ends of the spectrum here because on the one hand, I want to be clear, man, if you're in your 30s and you have a liquidation event and you net out $3 or $4 million, that is incredible. That is so insanely unique. I mean, that is less than 1% of millennials are in that position. Yeah. So kudos to you. That's fantastic. But then, as great as that is, as unique as that is, you're also not wealthy yet. Like you really aren't. And so you have to apply discipline. You have to have a very sound, disciplined allocation. And if you do take distributions to supplement lifestyle expenses, again, I think that's okay, even though it's a little bit controversial. You have to keep that to a 1 to 2% withdrawal rate. I don't want you to be at 3 to 4%.
And hopefully for the listeners that might be in this space, like, you know, compared to everybody in prior generations, they're absolutely crushing it. But, you know, like as you look up at the horizon of the expenses, hey, I want to live in the heart of Houston and send my kids to public school. You know, it's like, oh, wow, well, actually, I'm not nearly as financially independent as I thought. Like both of these things can be true. A, you're absolutely crushing it. And B, to recreate the childhood that you might have had in the core of Houston with the new post-COVID world, like it's a very different number.
Right.
Justin, anything else is, you know, I know in future episodes, we're going to kind of talk about different case studies. Anything else as you think about this person before we wrap it up?
I think I just want to say the reason that we say a lot of this is there's kind of two outcomes here. Jared, I think we can say, sure, like it is absolutely best if you don't upgrade your home and you continue to put yourself in a position where you can just live off of, let's say you're making $150 to $250 a year. That's incredible. Just live off of that and don't spend any of your payout. That is amazing. But then I want to kind of go to the other end of the spectrum. And the reason why I'm okay giving a green light on some of these major purchases, I mean, Jared, if you're 32, 34, and you're going to go right back into it and invest and take big swings and have potential payouts, well, there is a world where you're then 38 and you've got a $12 million net worth and a lot of it's liquid because these are exit events. You don't have to wait to buy a $2 million home until you have $12 million liquid. Like you don't have to hit that bar, but you do need to be very mindful, very careful about how you do it. If you're, still have young kids and you're getting a wonderfully incredible payout, but it's not a big enough payout for you to be financially independent.
Yeah, there's just a lot of opportunity, right? And I would say with it happening so early, it's not. I think that honestly, that's one of the best ways it can happen because it gives you freedom to think about what do I want. But it's not enough to where you say, hey, I never have to do anything again and I could just spend frivolously. And I can hit the eject button and never work. You could, but there would be some financial discipline involved, which again, I don't think is necessarily a great thing. I mean, part of our job as investment managers is to help clients understand a safe withdrawal rate. And that's two-sided, right? If you are underspending, we will tell you. Right. And with oil and gas, it skews engineers. So it's a lot of people that are very risk management minded. So luckily we have a lot more conversations about clients underspending rather than overspending. But so it's all thinking about, hey, what does life well lived for me look like? And what spending is in alignment with my values? And I don't think, like you said, spend a little today, especially if you plan to go back to work. And if you are the person that took the big swing and had the liquidity event, congrats. Are you able to recreate it? I don't know, might be a good time to de-risk, but you're also probably, if you're the person to take the big swing, you're also probably going to take future big swings.
And I think, Jared, a lot of this comes down to the idea that you don't have to put off fun expenditures in life forever. For some of you, it may be, I'm not a huge car person, but like for some of you, it may be a really incredible car. And that's awesome if that's what you want. For some of you, it could be a golf membership. It could be a bigger primary home or a vacation home. And so I think everyone has different things that they're excited about. And at this level, with this case study, I think you coined it well. You can do a lot of things, but you can't do everything.
Yeah, awesome.
And the things that you choose to do it wisely.
Love it. Okay, that's where we'll wrap up. Justin, to give people a sneak peek, what's the next case study related to this that we're going to talk about next week?
So the next case study I want to dive into, maybe you're in your 40s or 50s. So you no longer have young kids and maybe the number's a little bit bigger. Maybe it's more in the $5 to $10 million range is your payout. What are some of the implications that you should consider?
I love it. It's like we're looking at one M&A deal through like the 3 different ranks of employee.
Yes.
Cool. Awesome.
So excited
well, that's
to do
a good
it.
one. That's a good place to wrap up. Ideas for future episodes. Want to tell us about the mechanics of your specific deal so we can give you feedback? Love hearing from listeners. Podcast at brownleewealthmanagement.com. Thanks. We'll see you next time.
This podcast is for informational purposes only. Nothing discussed during this show or episode should be viewed as investment, legal, and tax advice. If you have questions pertaining to your specific situation, please consult the appropriate qualified professional.